Hey everyone, welcome to part 2 of our deep dive stock analysis on Tesla. If you missed part 1, definitely go check that out first, as this video builds off of the qualitative discussion we had in that video. I'll leave a card here for you to click that will take you over to that video now. In the last video, we ended off by determining that Tesla was operating with medium business risk. Based on this information, we can analyze Tesla's current and past debt balances to determine the approximate financial risk inherent in investing in Tesla stock. Based on the book values of equity method, Tesla looks very overlevered with an average debt to value rating over the past 4 years of about 70%. This would indicate that the company has high financial risk and management is taking excess risk to deliver better returns on equity. If you take a look at the quotes on your screen right now, this is not an unfair statement to make. These quotes were stated by Elon Musk about Tesla's cash burn in 2018. Something we need to consider is whether Tesla is in that same position now. Looking at market values helps because book values can be slow to react to changes to the operations or competitive dynamics. Here, we see that the market is predicting that the equity in Tesla is worth significantly more than what the book value shows. This is the exact reverse situation that Aurora was in, where in their case, the market was showing that the past investors had overpaid to acquire their shares. The average debt to value using this method ends up around 18.5%, which is below where we would want to see the company in normal situations. However, given the current economic environment and what this has historically meant for the automobile market, it may actually be a prudent management decision to have raised equity and reduced the company's debt to value. Overall, we can move forward with the assumption that management at Tesla are targeting a debt to value within the optimal range. Let's put the business risk and financial risk together to see if our analysis has painted an accurate picture. Right now, Tesla is recovering from a situation where they were single-digit weeks away from bankruptcy. However, while things look to have become stabilized, the current economic environment has created a lot of uncertainty in the industry and for this company. This, combined with Tesla's comfort with higher levels of debt, indicates that there is still an above ideal level of financial risk in the company. Given the additional factor that the stock is currently trading near its all-time highs, it makes sense for an investor to use a higher equity risk premium to better protect themselves from a loss. The next step is to determine the weighted average cost of capital, or WACC, of Tesla. I'll discuss 2 different ways we can do this. First, we can use the table shown before to determine the cost of equity for the company. In this example, I use the average of the book value and market value weights when determining the debt to value ratio. This equated to a WACC of about 8%. The second method for calculating the WACC is by using the CAPM method. This is a traditional finance method for calculating the WACC as opposed to a value investing method. So I also use traditional finance methodology for the other elements. I used market weights, net debt, rather than an average, and this resulted in a WACC that's slightly higher at around 8.20%. I'm going to stick with the first method for my analysis because the recent volatility in Tesla stock has really thrown the market weights out of balance. Finally, taking the market weights and infecting your DCF or EPV analysis with market sentiment is counterintuitive if you want your analysis to be independent and focused on the true intrinsic value. Essentially, we don't want the market's assumptions about Tesla to infect our own assumptions of Tesla in our DCF. Now we get to arguably the most important part of our pre-model analysis. Is the company generating returns on their invested capital above their cost of capital? So what we want to see here is Tesla's ROIC, or ROIC, above its WACC. There are 2 methods for calculating ROIC, both of which I will show on the screen. Unfortunately, we see here that Tesla is destroying shareholder value through its current operations. In cases like these, what we typically see in further analysis is Tesla's net asset value higher than their earnings power value. Put simply, this means that management is not utilizing the assets or capital to generate sufficient returns for their shareholders. However, in Tesla's case, the ROIC is clearly improving year over year, and some market participants have already started factoring this into their models. This is a red flag for most value investors, especially if they're trying to perform a value investing style similar to Buffett's, and this is likely where they would stop their analysis on Tesla. To understand how this can be the case, we need to look at a decomposed ROE analysis, which is also called the DuPont ROE analysis. There are a few key takeaways here. First, the asset turnover, which tests how efficiently management uses its assets to generate sales, looks phenomenal. This is one of the key things that's going to make Tesla extremely valuable in the future if Elon and management can deliver on everything that they have promised. This is because a lot of Tesla's future revenue looks like it's going to be following the SaaS, or software as a service, model. These companies have very high asset turnovers because sales growth doesn't always require significant asset growth. Second, the net profit margin, which tests how cost effectively management can generate its sales, looks quite poor. However, this is clearly improving significantly year over year. This was something that held Tesla back in previous years, but Musk has made this a priority over the past few years, and his efforts look to be paying off. As a bonus, if Tesla succeeds in achieving strong SaaS revenue growth, this will help improve their margins. Finally, Tesla's ROE looks quite poor because the company is highly leveraged from a book value perspective. This is why the stock fell 51% from mid-2017 to mid-2019. The company just wasn't generating sufficient cash flow to match the debts that they were taking on, which means that they were in financial distress, and the stock price reflected this. Investors need to remember that leverage is a double-edged sword. It's amazing for a company to have leverage when they make a lot of money, but it's also a very bad thing to have leverage if the company doesn't make a lot of money. So, the main thing Tesla needs to work on is their net profit margin. If they're able to get this ratio above 0%, the benefits of their high asset turnover and leverage will be reflected in the return on equity. Now we move on to our net asset value analysis. The first part can be seen on your screen now. This tells us the value of Tesla's assets today. The way we calculate this is by recreating and capitalizing the costs a competitor would have to incur in order to match Tesla's position today. We do this by correcting any distortions to asset values from accounting assumptions, and we add hidden asset values to the balance sheet. The two main hidden assets of Tesla are their product portfolio and customer relations values. We can recreate these hidden assets using the following processes. The large value attributed to the product portfolio is completely justified in my mind because Tesla's R&D has been nearly unmatched in their price point for 8 years. Bigger companies are spending more to catch up to Tesla, but are still struggling. This value also captures the benefit of human talent wanting to work at Tesla, given their mission and affinity for the company's products. Next, we look at Tesla's liabilities. Here, the main thing to consider is that a large portion of Tesla's convertible debt just came into the money. Option theory would suggest that these bondholders wouldn't exercise early, but rather just sell their bonds in the open market. However, I believe that the current economic turmoil, potential downside risk, and the illiquid bond market may cause many convertible holders to convert their debt into stock early. It's possible that Tesla could raise debt to pay out these convertible holders, as opposed to using stock. However, this dilution from the convertibles doesn't make a significant enough difference to look through all the debt covenants of Tesla's debt. If we were considering this investment back when Tesla was having some serious liquidity concerns, then it would be necessary to review all the debt terms and their cash position. Overall, the NAV analysis shows us that Tesla's assets are worth about $141.33 on a per share basis. However, the only time the stock has ever traded close to this value was when the company was in financial distress. Why? Well, that's potentially the only time the company would have had to list its assets for sale, which is why the company would have traded around that value. However, as I mentioned in my Aurora stock analysis video, the net asset value actually needs to be adjusted down if there's a Chapter 11 or Chapter 7 bankruptcy risk. This is because there are significant costs that a company accrues when they're going through these procedures. As you've guessed by now, the real value of Tesla stock is actually in its earnings power value, which we will cover next. If you find yourself able to grab Tesla shares near the net asset value level, like I have in the past, be grateful to have had the opportunity. The EPV analysis will also shed some light on whether Tesla is truly worth $900 plus per share, or if Elon was correct and Tesla is actually overvalued. For Tesla, unfortunately, we cannot make a simple EPV analysis. While the company isn't in deep financial distress right now, there is a lot of growth potential in the company, so we will need to build detailed revenue and cost schedules. Then we can run through an unlevered free cash flow schedule and bring the model home with a variety of sensitivity analyses on our discounted cash flows. The first thing to note, same as always, is that every good model should give you the ability to switch between different scenarios the company can endure. In this first draft model, I kept things simple and assumed a simple high, low, and base case set of scenarios. However, there's something a little special about Tesla that I add to at the end, and that it'll actually be something unique to this valuation. I determined Tesla's production capacities based on their updates to shareholders. However, when information wasn't available on an upcoming facility's capacity on a segment basis, I made some equations to compute what the implied capacity would be. So I applied Tesla's current output per square foot per year from other factories that they've already built, and I applied that to the factories that Tesla has in their pipeline. So while this is not a perfect way to determine Tesla's potential output of these new factories on a segment by segment basis, it's a good start and it's a good ballpark figure to have us in before Tesla announces those capacity figures. For most sales volumes and sales prices in the model, I used management's expectations wherever possible. But then I also computed some conservative assumptions from historical data whenever I had the information available. If anything else was done to model the numbers, I'll mention it while covering that specific segment. So for the Model S and X, I computed the recent quarter's distribution of sales between the two products and applied this moving forward. The current trend seems to be for SUVs to be gaining popularity, and I don't see this changing in the near future. I did make one important assumption about ASPs and sales volumes from 2023 forward, as I assume Tesla will eventually refresh the lineup around this time, which would cause a surge or could cause a surge in average selling prices and sales volumes, at least for the near term. For the Model 3, I assumed average selling prices would increase over time in all cases. So I also assumed nearly all sales would fall into the lowest price category in the worst case scenario, given the current economic climate. However, as the economy recovers and Tesla increases the price of its options, I believe ASPs will actually go up in the future. I used historicals to predict the average sales volumes for the Model 3. However, this may not be accurate given the potential for cannibalization between the 3 and the Y. What is also important to note here is that variations in the Model 3's projected sales volumes have a slightly exponential impact on our EPV the further they stray from these expectations. So this is mainly because with manufacturing intensive companies like Tesla, they must build factories which need significant investment for them to build these factories. So if demand doesn't actually meet the firm's expectations, this results in an escalating average cost per unit. And just like scaling a high fixed cost business can be very profitable, it has a mirrored impact the other way if Tesla or any other company with high fixed costs is unable to scale demand. So for the Model Y, I assume similar growth rates as the Model 3, except I started the sales projections at a higher base to factor in the higher demand for SUV products relative to sedans. This product, just like the Model 3, is crucial to Tesla's intrinsic value for the same reasons I mentioned above. Further, the improvement in margins I expect to see, and we'll cover in detail later, is largely actually due to this product. So if sales volumes struggle, we could expect to see margins stay flat or even decrease, which will have an extremely negative impact on Tesla's implied share price. So the semi-truck and the Roadster 2.0 are both, cost leaders in their market, and they're also market leaders in performance in their respective categories. So I expect both of them to do extremely well and average their current pre-orders with steady growth on a yearly basis, which are these figures. And for ASPs, I just took the average based on some pre-order information that I could find. If I couldn't find anything, I assumed worst case where most of the orders were going to the lower priced components. So the final product of sufficient importance to Tesla's valuation that I actually have time to discuss here is the Cybertruck. And I left this for last as it's the one product that I think will likely fall short of everyone's expectations. So this futuristic design that Tesla has for this truck is a great idea, but I don't think it's the right fit for this market. So I believe the pre-order numbers are pretty suspect, and I'm gonna lay out the following reasons as to why. So first, the Model 3 had cancellations, even though it was extremely sought after. And so I expect the Cybertruck to have at least the same percent of cancellations. Second, the Model 3 sort of set a precedent that buyers could pre-order and then sell their reservations for profits. So it's unclear how many Cybertruck pre-orders were bought with this intention. And third, buyers of trucks are very conservative about the looks of their truck, which is where I think, the Cybertruck will miss its mark. So if there are pre-order buyers who are looking to make a quick profit on locking in their spot, there may not actually be enough people willing to buy their spots when the car nears delivery, and at which point these pre-orders will actually become into cancellations and refunds. So to account for these factors, I assumed a 20% refund rate as opposed to the Model 3's 12% refund rate. And so that basically gave the Cybertruck 200,000 in sales volumes, which I assumed would go unchanged. So I determined the average selling price of the Cybertruck based on the distribution of trucks pre-ordered, which Musk gave us some information about, and so I used those to determine the weighted average selling price for the truck going forward. So unfortunately, the energy, insurance, superchargers, and other business lines just did not make a sufficient enough impact on revenues to warrant some additional modeling and assumption building here. However, we can add to these segments as quarterly reports come out and as we reevaluate Tesla's position, if that's what my subscribers want to see. In terms of gross margins, for all the reasons we talked about when analyzing Tesla's strategy, I believe Tesla's margins will actually improve significantly over time. So the key reasons again were sharing of components between high volume products, which is the Model 3 and the Model Y, the increasing proportion of revenues from software-based products or services, which has to do with their ability to scale with low costs, then increasing sales volumes while focusing on cost control and efficiency. So this is actually part of Elon's final component of that massive compensation plan that Tesla made for him. Basically, he must bring Tesla to a gross margin of 30%. So it's very likely that he's going to be motivated to focus on this aspect of the business, as he's got a sizable bonus if he's able to bring this about. As full self-driving comes closer to full capability, Tesla is able to recognize more revenue from each sale it makes and put less into deferred revenue. So this is basically an accounting concept. If you want to understand what deferred revenue is and why some companies have to do it, a simple Investopedia search should give you the answers you need. So the pre-EBIT expenses were fairly straightforward to model out. The information was either given through guidance or I approximated based on expected fixed costs that were needed to open additional factories. However, R&D expenditure is uncertain, and I will likely need to update this as time progresses. I also made some assumptions that SG&A expenses would spike in certain years where I believed factories would need to be built. So for capital expenditures, firstly, the maintenance Capex was simply rolled forward based on past trends and additional depreciation expenses from past Capex, as well as the additional strategic Capex. And then this strategic Capex I modeled based on when the factories were expected or likely to be built and worked on, and then stopped them once they were brought to full functionality, and then again restarted when another factory was going to be built, which sort of follows the SG&A model there. Depreciation was computed based on Tesla's assets currently on the balance sheet, as well as any additional capital expenditures the firm takes on in the projected years, which I showed above. The assumption made here is that Tesla's assets have a weighted average useful life of about 12 years. So this was sort of given in the 10K. However, proper weighted average useful life wasn't given, so I had to make some assumptions based on the limited information I had, and 12 years seemed to be about fair given the mix of assets that Tesla was holding. So now that we understand the main factors that will impact Tesla's earnings power value, we can build out our revenue schedule and look at the main contributing segments, as well as any potential capacity constraints. There are two main takeaways from this revenue schedule. First, the Model Y and Model 3 make up nearly all the revenue for the company, and the other segments are largely insignificant. Second, the Model Y will likely run into some capacity issues in 2021, which we can see. Second, the Model Y will likely run into some capacity issues if it continues on its expected sales volumes in about 2021, but then I assume that there would be no issues going forward if management's expectations of capacity are accurate. The Model 3, however, will likely run slightly over its max capacity, unless, of course, there's some cannibalization that I mentioned from the Model 3 to the Model Y, which shouldn't be very problematic since the two cars share a lot of its components. They can really share a lot of this capacity. So essentially what this tells us is that Tesla's short-term priorities should be the Model Y, and over time, if there seems to be no cannibalization and demand for the Model 3 stays strong, then they should consider adding additional capacity, as their sales volume cannot grow as it's being limited by the capacity in future years. So since this isn't going to be a very, very complex model where we track all the cash flows through a three-statement model, we can actually move to the second last step, which is determining the unlevered free cash flows Tesla can produce for its shareholders. There's not much to say here since the assumptions and numbers driving the unlevered free cash flow have already been covered. If you've watched most of my videos, you know by now that one of my goals is to never lose money in the stock market. My acid test for this is looking at the EBIT margin and whether it matches with the qualitative factors we were seeing when we first started looking at the company. In this case, we know that there are a lot of factors potentially driving up Tesla's margins, and we also saw them reducing fixed costs on a yearly basis. So both qualitatively and quantitatively, the expectations around margins, at least in my opinion, are great. So this should translate to higher and better cash flows generated from operations. And then this self-funding can eventually lead to a reduction of shares outstanding via buybacks, creating tremendous shareholder wealth. This is a topic I can cover in more detail later on, but there's definitely no reason to be against smart companies using buybacks intelligently. So finally, we create a discounted cash flow valuation schedule with the goal being to find a range of potential valuations based on both varying growth rates and varying amounts of risk, which we can capture in the WACC. There are a few important things to note here. First, Tesla's value is clearly trapped in its terminal value, meaning that it's still in its infancy and there's a lot of growth left to be realized. However, this also lines up with the qualitative analysis, which showed that Tesla still has a lot it needs to achieve before it can command these valuations. So if Tesla fails to do something like scaling the Model Y, the damage or reduction in the share price will be extremely, extremely strong. Second, I mentioned that Tesla must create new factories to scale production. And since Tesla is not able to self-fund their operations yet, the net debt and shares outstanding figures here will actually be a little bit too low right now. This is something that we can update on a quarterly basis if everyone wants to see an actual complex financial model that I built for Aurora that breaks Tesla down into its 3 financial statements and projects them forward. However, if you want that, let me know with a comment down below. So third, while a 4% growth rate into the future may seem low to some people who don't know how this formula works, I wanted to shed some light on this. A growth rate above 4% is next to impossible, as it will be stopped by regulators almost immediately. So, for example, let's say the toy making industry grows by 4% on a yearly basis, right? The overall industry, which encompasses all the toy sales overall. So now let's take toy company FS, which grows at 5% in the terminal value. That's basically saying that into infinity, it grows faster than the industry by 1%. So this is actually not possible, because this would mean that eventually this toy company FS would become larger or become the industry. And this is just not possible, as monopolies are not allowed to operate in most countries and industries, and the regulators in these places will do everything possible to stop this. For example, when Microsoft was growing at exponential rates, which seemed to look like they would grow at 20% or something insane into infinity, regulators stepped in and started trying to slow down the growth and letting competitors catch up. And eventually, while they were unable to split Microsoft up, the damage was already done and competitors had caught up. However, this is not to say that Microsoft is not a phenomenal company. It very much so is, and I personally do own shares in Microsoft. That being said, I don't expect them to be able to grow at the current rates they are into infinity. So overall, it's amazing to see that Tesla has the potential to run up by a tremendous amount, even while using more conservative growth rates and a more conservative risk profile. However, there's something missing here that I know a lot of people are wondering about, which is Tesla's Robotaxi plan. So let's talk about it here and discuss how we can potentially value this business line. To understand the value of Tesla's Robotaxi plan, we need to ask ourselves a question. Will robotaxis be a thing by the end of 2020? So I personally have to say a hard no to this for 3 main reasons. First, from an ethics standpoint, we have to understand that even though most Tesla owners think their cars are ready to fully drive themselves with no human intervention, they're not the only drivers on the road. There are other drivers and pedestrians on the road who aren't willing to risk letting a car drive itself when there are still bugs that the software is working out. Second, human nature is flawed. Robots and technology can do most menial tasks better than humans, and the amount of recklessness they will engage in can actually be programmed. So someone's ego may have them believe that they're a better driver than a robot, when statistically speaking, this may not be the case. For example, a robot may drive safely 99% of the time over 10,000 trips, but there are people who would argue that because they've never been in an accident and have a 100% safe driving track record over an average of 1,000 trips, that they're the better driver. They won't account for luck, for near misses, or any other statistically significant factor. This is something that will actually slow down the time it takes for self-driving cars to be approved by the regulatory bodies on a large scale. Finally, the biggest issue is that Tesla's neural networks are only amazing until they encounter a novel situation that needs a driver's intervention to teach or train it what to do. So recently a video emerged of the Model 3 where it was traveling on a highway and it came across a turned over truck. This should have been a routine scenario for the car. Given its sensors, it should have been able to sense and see the truck laying flat far before any human would, and it should have started applying the brakes or warned the driver even earlier to take control of the car. However, it was unable to do this, or the driver was unable to take control, and the car smashed straight into the truck. So even though these cars are getting better and better every day, things like that can still happen. So because we have social media now, we tend to see these things more frequently, which creates a bias in our mind that these things are happening more frequently than they actually are. In any case, as Elon has said in the past, training a car to travel a predictable path with predictable obstacles is a piece of cake and can be done within a few hours. In fact, there's a YouTuber named Code Bullet that showed just how simply this can be done on a predictable track. I'll say this, over the average trip, a trained neural network will outperform most drivers as it has numerous sensors, potentially can also have lasers, and it has cameras that can all function at the same time, whereas humans are working with 2 eyes, 2 ears, and a limited field of view. So I do think one day robotaxis will be a normal sight. The only issue I have is that we do not know when this will be, and we do not know how much it will be worth. So I decided to make this valuation extremely simple. I took the market cap of Uber, which of course assumes that Uber is fairly valued right now, and I used this as a proxy. So my logic was that Uber will never be able to undercut Tesla if Tesla succeeds in automating the rideshare process. So this is because Tesla will be making the cars, owning the software, incurring minimal storage costs if Model 3 owners are renting out their cars. And based on these advantages, Tesla would be able to undercut Uber on all rideshares and effectively attain most of Uber's potential revenues. And so thereby, Tesla would actually basically encompass their market cap. So I did also make some additional assumptions. For example, Teslas are luxury cars, so they probably aren't able to service all the demand that Uber is able to service. So essentially, I assumed that the countries with the wealthy populations would use Tesla's ride-sharing network, whereas the poorer countries may not be able to take advantage of this ride-sharing network. So I cut Uber's market cap effectively in half, just as a proxy and a placeholder for now, until I can eventually do more research on this. So then I took this additional value of $28 or $29 billion for Tesla, and then I divided it by its current shares outstanding to get a value of it on a per share basis. So this isn't, of course, a perfect way to value this company, as there's a lot more that goes into it. For example, if Uber's market value is determined accurately, its potential cash flows are being discounted at a different rate than Tesla's would be, and so the revenues in Tesla's hands may actually be worth a lot more than they are in Uber's hands if Tesla is able to scale that ROIC and get it far above its WACC, which is not something Uber has been able to do as of yet, and so shareholders aren't really expecting that right now, which could explain why Uber and Tesla would be able to do very different things with that cash flow and use it very differently. So this is a bit more of a complex financial concept, so I won't go into it. But just so you know, this is by no means a perfect way or even a great way to value this. This is just a starting point. I want to see and I want to get some community engagement as to what you think is a great way of valuing this product or service, and then we can implement that into our next video on Tesla. So the final question we need to answer as an investor is, what price is fair for us to target when trying to build or add to a position in Tesla? The way I like to think about this is by using the following method. Essentially, we don't know with certainty whether Tesla will be able to generate the cash flows that we have projected for them. However, we do know the value of Tesla's net assets with some certainty. So we can take that net asset value and add a probability adjusted EPV balance to it. So we actually determined this probability of Tesla sustaining its competitive advantage over its peers near the beginning of our analysis. And I think that 80% value that we assigned at the beginning is still fair based on everything else that we've seen through our analysis. So we now just follow the formulas on your screen, and based on this, we come up with a more conservative intrinsic value using these formulas. And we need to remember that the return we get on an investment is a function of the price at which we buy the stock at. So we never want to buy a stock at its intrinsic value, because then there's limited known upside based on our analysis. Therefore, we apply a margin of safety to this value. So I use 2 different margin of safety values depending on the company that I am analyzing or looking to buy. So if the company is a proven, safe company with predictable earnings growth and a proven track record, like McDonald's, for example, I'll use a lower margin of safety value at about 33%, as I'm more confident in my projections and my understanding of where the company is going to be in a few years. However, in the case of Tesla, there is a lot that could differ in the coming years relative to our projections. For example, Elon could get in trouble with regulators and be forced to step down. A competitor could obtain some great technology from their Formula E team, and a whole variety of other things that could go wrong. Given these potential risks and the immense impact that they can have on our projections, I'm going to use a 50% margin of safety when investing in Tesla and in other highly speculative growth companies. Based on this, we come up with a suitable entry price of about $1,030 per share. And the market price when I began this long-winded analysis was about $818. So as long as the market price is below the entry price, I'm fairly comfortable adding some money to the position. However, I'm definitely most comfortable adding money to strong companies when they're trading near their net asset value. This is because I know that their net asset value isn't likely to diminish significantly, as they're not usually in a high risk of bankruptcy, and even if the company does have to take on some additional debt or issue some additional equity, I'm not as worried because I know in the long term, once the business begins to recover, they'll be able to use their strong competitive advantages to create additional cash flow from operations and use that to offset any additional debt or equity that they may have had to issue to take on some tough times. That's typically how I look at strong companies and when I want to add some money into them. So I really hope you enjoyed this video. It took me hundreds of hours to make, so if you haven't already, please leave a like, comment your thoughts below, subscribe, and hit that bell notification, as all of that really helps the channel. Almost 90% of my viewers aren't subscribed, so I'd love to have you all in the community. I'll also leave a link to the channel's Facebook group down below, where I poll my subscriber base on which stock they'd like to see covered in depth in the following month's deep dive stock analysis video. So if you'd like to see a stock that you're interested in covered in this much detail or more potentially in a future month, definitely join that Facebook group. So I'll also be adding a resource down in the description below where beginner investors and even some intermediate investors can learn the core concepts of finance in video form from some great professors in Canada, and all of it for free. I'm not sponsored by that link. I don't make any money off of it. I didn't even go to McGill. However, I know a lot of the analysis I do in these videos looks complex and daunting, but it's not so complex once you've learned the basics. And I really want to help everyone learn through this channel. So do check out that link below if you want to learn some more and you have the time to commit to this. Finally, always remember to be eager to learn, willing to invest, and prepare yourself for success.